Regardless of where you fall on the political spectrum, most of us can probably agree that November 3rd can't get here fast enough. You may be tempted to go into defensive mode to protect your investments, especially if you're feeling nervous about the election outcome. But making decisions about your portfolio based on politics usually isn't a sound strategy. In this video, we're going to talk about the 5 money mistakes to avoid during election season. Hey everyone, I'm Jennifer at Diamond Nest Egg, where we teach you how to break the paycheck to paycheck cycle, pay off debt, and live a debt-free, financially free life. To learn everything you need to know about saving, investing, and retirement, smash the subscribe button and hit the bell. You'll be notified every Sunday when we bring you the latest and greatest money moves from New York. So let's get started with the first self-sabotaging money move you should think twice about when it comes to your money this election season. And that's ignoring the long-term growth of the market. When we look at the past nearly 9 decades, U.S. stocks have gone up over the long term, regardless of whether a Republican or Democrat won the White House. Here's an example of the S&P 500 index dating back to the 1930s, when Franklin D. Roosevelt became president. Think of the S&P 500 as a barometer for how the stock market is doing. This index tracks the performance of the 500 largest publicly traded companies in the U.S. As you can see from this chart, created by Dimensional Fund Advisors, a $1 investment in the S&P 500 index when FDR became president in 1933 would be worth more than $9,200 in 2020. It would be worth even slightly more today as the markets have rebounded a fair bit since this chart was created a few months ago. The red sections denote Republican presidencies and the blue sections denote Democratic presidencies. Have there been periods of stagnation when markets just move sideways? Yes, take a look at the Nixon-Ford eras. But generally speaking, regardless of political affiliation, nothing can hide the fact that markets have trended upwards in the long run. So as long as you're invested for the long haul, election 2020 is just noise that you can turn down a notch. In case you're wondering whether you have enough money to start investing in the market, remember, it doesn't take a lot. You can even start with $50 or $100. I know investing can be very daunting in the beginning, so download our financial guide. It's right below this video and grab your budgeting template. Figure out if you have anything extra at the end of each month to start slowly dipping your toe into the markets. Let's move on now to the second self-sabotaging money move you should not make when it comes to election 2020 and your money. And it's this: forgetting that elections, presidents, and the government do not decide how companies and consequently the markets perform. Yes, elections, presidents, and the government can determine policies. They can raise or lower taxes. They can approve mergers and break up monopolies. And someday they might even break up Amazon and Facebook, just like they broke up AT&T and Standard Oil a long time ago. So if elections, presidents, and the government do not decide how well companies and markets do, who does? These folks right here. These are the executive management teams from Apple, Google, and Facebook. I would have loved to put Amazon up here because a lot of you know that I am an Amazon fan, but the executive management team pictures from Amazon's website were simply not as nicely laid out as the ones here. At any rate, as of a few weeks ago, Apple, Google, Facebook, and Amazon, as well as Microsoft, made up more than 20% of the S&P 500 index that I talked about earlier. As a reminder, the S&P 500 tracks the performance of the 500 largest publicly traded companies in the U.S., and it's a barometer for how the stock market is doing in general. These executive management team members, I'm showing you right here, these are the people with the mandate to drive the long-term success of their respective companies. And on the most fundamental level, when companies like theirs do well, the markets do well. Regardless of whether Trump or Biden is elected, regardless of the policies, business restrictions, or anything else that may come from the election results, these folks that you see here, it's their job to continue to develop new products, keep their customers and employees happy, grow their revenue, and increase shareholder value, which in turn will drive earnings growth and propel their company's stock prices and market indices higher. And even as politicians and laws change over time, it's the job of the executive management team of these companies and others like them to work with what politicians give them, and sometimes to lobby against it so that they can build the best companies possible. It also doesn't harm that most of these executive management team members have a lot of their overall compensation tied to the growth of their company's earnings and stock price. It's these folks and their ability to make your investments worthwhile that you should be focusing on. So as a long-term investor, these are the people you should be watching. For those of you that watch TV a lot, these executive management team members, they're the big show. The election is just the commercials. So focus on the show and not the commercials. And just as we do in real life, when the commercials pop up, let's turn down the noise and grab a beer or water from the fridge instead. All right, now let's move on to the third self-sabotaging money move you should think twice about when it comes to your finances this election season, which is trying to cash out of the market. Every presidential race comes with uncertainty, and this one is no different. In fact, many financial experts would argue that the stakes are even higher with election 2020, given the lack of clarity around the pandemic, unemployment levels, and speed of economic recovery, just to name a few of the things that are top of mind. Uncertainty always makes Wall Street nervous, and this high level of uncertainty makes Wall Street very nervous, which means investors are even more tempted to cash out as Election Day 2020 approaches. Based on evidence compiled by the Capital Group, over the past nearly 3 decades, cash inflows into money market funds have gone up threefold during election years compared to non-election years. Money market funds invest in extremely low risk short-term debt, so their returns are generally similar to the interest rates on high yield savings accounts and CDs, which means at the moment, it's super low at less than 1%. The only thing that's predictable about market ups and downs is that they will happen. We just don't know when. If someone could predict the markets, Wall Street would have caught on by now. And this would be one very wealthy individual, because we would be paying him or her lots of money to tell us where to invest our own money. So while the outcome of the election could cause the stock market to dip in the short term, especially if the results are disputed, as we've already shown, historically, the market has rewarded those who stay invested over the long term. Cashing out of the market during election season might mean that you don't catch the market dips, but similarly, it might mean that you also don't catch any of the market upside. Once you've taken your money out, how do you even know when it's time to put your money back in? This leads super nicely into the fourth self-sabotaging money move you should avoid when it comes to investing your money during election 2020, which is this: trying to time the market. And this includes waiting until after the election to invest. Trying to time the market for any reason, including an election, is very often a losing strategy. If you're waiting until after the election to invest, here's why you should reconsider. Let's look at these 3 possible scenarios based on the Capital Group study of the last 22 election cycles since 1932. In the first scenario, on the very top, you invest at the beginning of an election year. So in our case, January 1st, 2020. In the second scenario, in the middle, you make monthly investments for 10 months leading up to election day. This is similar to a 401k retirement plan. And in the third scenario, on the very bottom, you wait until after the election to invest, when there is full clarity on the election results. So on January 1st, 2021. What Capital Group found was that over a 4-year holding period, meaning you keep these same investments for 4 years, investing in a lump sum after the election results are clear, so the third scenario at the very bottom, would have produced the worst returns in 16 of the past 22 to elections. On the other hand, had you just ignored all the election noise and stayed invested, you would have come out way ahead. The results are clear from the study. Whether you're a lump sum investor or you practice dollar cost averaging, which is what most of you are doing when you invest a consistent amount every month via your company retirement plans, you'll come out ahead if you don't try to time your investments around politics. As we've been saying, the best strategy is to ignore the election altogether. The other issue you have when you try to time the market is this, and we already touched upon it briefly. Not only do you have to figure out the best time to get out of the market, but you also need to figure out the best time to get back in. In any given year, there are a few very strong trading days when the market makes some of its biggest gains. Again, the issue is that because no one can time the market, otherwise they'd be richer than Amazon CEO Bezos already, no one knows when these trading days are. So let's play a fun and somewhat interesting game and assume that you invested $1,000 in the S&P 500 index in 1970. This is what you would have in 2020. What if you got antsy at some point, decided to sell, and then decided to buy again? And what if during this period when you sold and were out of the market, you missed the best performing day in the S&P 500? What would you have? You'd have 10% less at around $108,000. Now let's take this one step further. What would you have if you missed the 5 best performing days or the 15 best performing days of the S&P 500? Or worst case, the 25 best performing days of the S&P 500? The answer is less, and horrifyingly less. I'm sure you're sensing the theme here, which is this. When it comes to election 2020 and your money, stay invested for the long haul. It's often easy to fall off track when you're managing your money, especially when there's so much going on around you and around the world. Check out this video on the money habits that keep you poor and learn a few time-tested strategies and tips on how to stay financially on track even when everything around you seems to be falling apart. Do not let short-term chaos, do not let short-term noise distract you from your long-term financial goals. And now let's keep going with the 5th self-sabotaging money move to steer clear of when it comes to election 2020 and your money, which is this. Do not focus on short-term volatility. In the stock market, volatility refers to big swings in either direction. For example, when the stock market rises and falls more than 1% over a sustained period of time. That's called a volatile market, which we've seen a lot of lately. Stock market volatility tends to be high in November and December immediately following an election. The best thing you can do is, you guessed it, ignore it because markets have been shown to bounce back in the long run. Short-term volatility has very little impact on long-term results. So avoid the urge to sell just because the market gets a bit bumpy. The other very important thing to remember when it comes to putting your money in the market, generally speaking, but especially when there is this level of short-term volatility in particular, is this. Make sure you have an emergency fund before you start investing. Never invest your emergency savings. Check out our emergency fund playlist right here to learn why. These videos also walk you through how to calculate the emergency savings you should have during a recession and how to give your emergency fund a boost if it's not quite where you want it. So to recap, stay away from these 5 money mistakes and stick to your long-term financial goals. Do not self-sabotage and avoid mixing together election 2020 and your money. The first mistake is ignoring the long-term growth of the market. Are there dips and periods of stagnation? Yes, but as we showed earlier, $1 invested back in the days of FDR would now give you more than $9,200. The second mistake is forgetting that elections, presidents, and the government do not determine company and market performance. It's the folks that run these companies, the executive management teams, that drive company and market growth. The best companies and the best executive management teams are resilient. They will figure out ways to drive company growth, customer and employee satisfaction, earnings per share, and overall shareholder value so that they can push their company's stock prices higher. They are the ones we should be focused on when it comes to our money and investment, not politicians. The third mistake when it comes to money in politics is trying to cash out of the market before or during an election. Yes, cashing out means you don't get the market swings down, but it also means you might miss the market swings up. Which leads us to the fourth mistake, trying to time the market. When you cash out of the market, not only do you have to figure out the best time to sell, you also have to figure out the best time to go back in. No one can time the market. We've also shown you with our chart the increasingly dismal results you get as an investor if you keep trying to move in and out of the market and miss the strongest trading days of the year. And the fifth mistake to avoid when it comes to money in politics, and that's to keep from getting spooked by short-term market volatility. Yes, prices swing drastically in election year and the few months after that. In fact, prices can swing widely on any given day, week, or month, even in non-election years. But in the long haul, I cannot repeat this often enough, the stock market continues its general upward trend once the dust settles, once the uncertainty is diminished. Don't change your investment strategy based on election predictions. Election 2020 will influence our lives in many ways, but who becomes president probably won't have a huge effect on your stock portfolio longer term. According to a Fidelity analysis of stock market returns going back to the first presidential election in 1789, regardless of whether a Republican or Democrat is president, stock market returns tend to be below average for the first 2 years of the term and above average for the last 2 years. Most financial experts agree that the biggest risk to Wall Street isn't who wins. It's not having a clear winner. And even then, as we saw from the contested election of 2000 between Bush and Gore, the impact on your investment portfolio will be softened so long as you're invested for the long term, as we've already shown in this video. If there's another stock market crash, it will most likely be less election related and more driven by broader economic events like another wave of coronavirus related shutdowns or widespread defaults following an extended period of financial stress. Election 2020 shouldn't affect your money decisions and overall long-term investment strategy. So don't self-sabotage this election season when it comes to your finances. Don't let the potential for short-term external chaos distract you from your long-term financial goals. If you enjoyed this video, give us a thumbs up and hit the subscribe button and turn on the bell. You'll be the first to know whenever we post another money saving, investing, or retirement post every Sunday. Next week, we'll be wrapping up our emergency fund series with an episode on where you should keep your emergency fund savings right now. In the meantime, check out some of our other stuff on this channel to give your finances a boost.